Welcome to Lending Times. This is episode number 42. This is Ryan Ross in London, and George, you're in New York again.
Yes, I am. I'm back home.
Back home in New York. Welcome to the Big Apple once again. We got a few articles to talk about. We have some events to talk about, to catch up on. Let's start for episode 42 on the articles. The first one that really popped this week, the latest PeerIQ loan performance monitor. We've done a few of these, I believe, in the past, right? Talked about them?
Yeah. So PeerIQ took advantage of the fact that Common Bond did a securitization. And they are advertising their loan performance monitor now, which tracks interest rates, delinquency, charge-off rates for both platforms across vintages and grades. For Lending Club and Common Bond. And, of course, the interesting part is the actual securitization and the data behind it. But also, the reason I wanted to talk about this is because transparency and online lending go hand in hand. So it used to be that all the loan information was a paper document that went on a shelf somewhere. And when you bought 10,000 loans, you pretty much got the right to look at the papers whenever you wanted to go to the warehouse and go through the folders yourself.
Mm-hmm.
And then
you had that option.
Yeah. And then now with online lending, all the data is electronic. So there's really no excuse from when you actually buy 10,000 loans to have real-time access to every single piece of data on what you're buying. All the information attributed to every loan, the performance data, the real-time performance data, who's paying, who's not paying, when their payments are due, and how their credit profile is evolving over time. But also how what you bought compares to other packages and the market overall and the economic and delinquencies rates and so on. So we're getting there. Tools are needed, software is needed, people are building it, and PeerIQ is one of a few different companies who are working on this. And the data is interesting too. So we just talked about the tools. We also can talk about the actual data and the performance. And you can look, for example, at the Lending Club delinquency by vintage. And you can see that actually the 2016 ones were not the best at Q2. But the 2016 Q4 already got much better delinquency than Q2. So overall, and I think it's one of the most important messages you'll hear on this podcast and most important information, the delinquency was getting worse and worse between 2013 and the second quarter of 2016. But ever since, it feels like it's improving. And it's too soon to say for sure. But it really feels like it's improving.
So the delinquency rate is going down?
Yes.
Okay. Do you think that is a function of any regulations, or is it just general? Is it good credit analysis?
That's a great question. So I don't know for sure. I don't work for the platforms. I can only guess. But my best guess is that each platform has to make a choice between volume of originations and quality of the originations. So if I need to lend out $2 billion today, I go down the street and I said, who wants a loan? Guess how many hands are gonna get raised?
Yeah.
Anybody.
Yeah.
And then I have to start saying no. Yeah. And if I say no to too many, I won't find enough people to lend my $2 billion to. And if I have to lend this $2 billion, because otherwise I don't make enough fees and I have payroll to make and I have rent to pay, then I'm going to have an issue. I have to do a layoff. It's going to look bad for the company. The investors are going to be in my back. So all of these companies have to do always a trade-off between how much they lend versus the quality of the borrowers.
Yeah. It's interesting. Yeah. Oh, keep going. Well, I was going to say, this reminds me of Brewster's Millions. You ever see that movie?
Nope.
So the guy's like, I will give you $100 million. He says this to his nephew or something. But he's like, but first, I want you to spend $30 million in 30 days. And he's like, how do I even
let me do it.
Doing
I'll help. I promise you, I've never had such an issue.
Cool. Okay, let's redirect. Talk about FinTech companies. SoFi, they're going to add 400 Delaware workers. Why Delaware?
That's a good question. I don't know. Probably a good place to find cost-effective call center people. So these 400 employees they're hiring by end of 2018, so by the end of next year, are call center jobs. But this for most of them. But there are also IT, business development, management positions. Out of the first 200, 2/3 will be call center, 30 will be mortgage operations jobs. Knock knock. What does that mean about their products and stuff? And 40 will be IT, business development and office staff. So of course, when you have so many people, you need IT and so on. But why Delaware? It's a good question. I don't know. I mean, it's probably cheaper than in California, cheaper than New York. You can probably find good people. And I would assume that there are some other call centers for similar products that are within driving distance of this call center. So they're trying to raid the call center for other financial institutions for these employees.
And they're betting on the fact that mortgages are going to be in higher demand. Yeah,
well, I guess so. And 2/3 are call centers, so probably general purpose, but 15% are mortgage people. So that means they're selling more mortgages. And remember, this is happening while SoFi is applying for industrial charter bank. Talking of which, yesterday, Financial Times had an article saying that an association of 5,000 community and small banks have come out against SoFi's application for a bank license, because they are concerned that if SoFi gets such a bank license, they will not have to follow the community reinvestment rules and stuff like that. I think that's absolutely not the case. I can't imagine a regulator who lets somebody get a bank and allows them not to follow the regulation.
Well, that's
it's misperception there.
This presents a really interesting segue. Last week we saw Amazon buy Whole Foods, and this next article is saying that Amazon has secretly become a giant bank.
Yes.
Tell me about that.
This is one of the most popular articles over the last few weeks, who also led to a bunch of follow-up articles also on the same question. So this takeaway is that Amazon Lending Services has passed 3 billion, would be like a boy, in loans to small businesses since their launch in 2011. That's a huge number.
$3 billion.
Yeah.
Damn.
So what they're doing, they're actually financing the merchants who sell the products on Amazon.
Yeah.
Why are they doing that? Because
let me guess. I don't know the answer. Do they want to actually help those companies pay for Amazon Web Services?
It's not only that, but they want, yes. And Amazon is doing this because they want Amazon to make more money. It's always the thing, Whenever a company is doing something, it's because it's watching for their own interest. But what's really going on is that to sell stuff on Amazon, you need inventory that's held by Amazon in their warehouse. So you have to pay for a lot of inventory. If you're selling for 20 grand a month of stuff, you probably want 3 months of inventory. So you probably need to have 60 grand of inventory stuck in Amazon warehouses. And for many people, that's a lot of money. It's difficult to come by. The takeaway, once again, there is that Amazon knows who's selling on Amazon, what on Amazon, what the customer feedback is, what the returns are, what the stock is, and they have this in their warehouse. So it's really easy and simple for them to give you a loan, because if you don't pay the loan, they have the inventory you already have with them. And they also know what's going to sell, what's not going to sell, and what they need to do in order to make it sell. So it's a self-fulfilling prophecy. I would be a little bit concerned about monopoly problems, because now you may be tempted to give priority to people you gave a loan to sell their products first. And now you wonder, it's like the Uber drivers, they're doing all drivings, they own the cars, they repair the cars, they put the gas in, but they actually make this, a relatively small share of the income. And the same thing, like the guys find the product, make the product, ship the product, provide customer support. Amazon just sells it, but now Amazon in addition of making their fees, they also make interest on the loans, and they make pretty much even more money on these merchants. So at the end of the story, I don't know how Amazon is not profitable.
Well, they're investing so much money in R&D and groceries.
Apparently, 13.6 billion in groceries. It's a lot of groceries,
So let's talk a little bit more about banking and why banks are going to survive. The next article.
Yeah, so that's a very good question. Just 1 second, I lost the article for some reason. There we go. So this is an article from Forbes, and it's a very, very interesting approach. The idea is that the banks are platforming, or in other words, the platformification of banks. So according to an Accenture study, 59% of banks, and there's a link to the actual study in the article, are creating full stack platforms.
Okay.
And
let me see.
Yes.
What does it mean by full stack?
Means an online platform that goes from finding the borrower to getting the application, underwriting, getting the whole thing.
Uh-huh. So they're just helping their clients as a total repository of all the services, so that their clients can just basically be brands at the end of the day.
Yes, but the banks are doing this themselves.
Okay.
So they're not necessarily building it in-house, but they're putting in place a solution. So that's 59% of banks. Now, by the end of 2019, according to another research by Gartner, 25% of retail banks will use startup providers to replace legacy online and mobile banking systems. So that's very interesting. Now, because banks and startups typically don't get along very well, and banks are concerned about their reliability, stability, all of those things in ET, for all the ET things for the startups. And they tend to prefer large companies. And you might have seen the news that D+H and Microsys actually, I think it was Microsys, have actually become one company. They merged. Those are one of the two largest companies who provide technology to banks. So banks love working with large companies like that. Other alternatives like IBM and so on. So banks working with startups is unusual, and means startups really have a lot of value and things to bring and to add in order for the banks to want to do this and be comfortable with this, and be willing to make the trade-off for this, more to be more precise.
You know what I'm also seeing is a lot of banks are starting their own incubators.
Yeah.
So that they can, I'm guessing, absorb those companies that they're incubating.
Yeah, that's true. I at least know what's going on.
Yeah,
and be in the middle of it. What's hot right now.
They can listen to them.
Yeah, just give you an example. LendKey, which pioneered the lending as a service in 2009, already has about 300 banks and credit unions as customers.
Mm-hmm. I remember
so this is the kind of thing.
We talked about LendKey.
Yeah, we did. We talked about a few other similar companies who compete with them, and there's many other options like this now. I know a few other companies who do the same thing as LendKey as well. So, for example, but there's also alternatives. So we talked about LendKey, how they provide the white label platform to the banks. The difference is that Wells Fargo, for example, they were really open to platformification. So Sigfig is another company which allows Wells Fargo customers to build, implement, and rebalance portfolios online. So it's below lending. This is happening in the other parts of the banking.
I see.
and the other one. So I can see this, and I've read articles in the past that said that banks, the future bank, will actually be a mismatch of a bunch of different APIs and services where different partners provide, consume, or use. So think of them as a hub, which forces standardization and is a center for regulation, is a center for transparency, is a center for communication, data transfer, and so on. But they're a service provider. Everybody provides and takes from, through established and regulated ways, information, data, money, all kinds of stuff like that. So it's a very interesting view of the bank of the future.
Really, really interesting. Because I was reading some article today and it said people don't like banks. They like going to a concert. They don't want to have to deal with the bank. They just want to have the process be seamless.
That's true.
And after a technology becomes so ubiquitous that it fades into the background, that's where you know it's useful. You know, people don't even realize how useful it is until they can't even see it. It's like a zipper. Everybody uses zippers, but not many people appreciate what goes into having a zipper on their pants. I don't know if that's a good analogy or not.
No, it's not.
Anyway, let's talk about some events, right?
Okay.
There was a meetup yesterday, PwC and Citibank. Tell me about that. How'd that go?
So we did in partnership with PwC, Citibank, and GDR. We had a panel on the new systems and new ways to give investors confidence in online lending. And it was a very, very, very interesting panel. The main takeaway was that after the Lending Club crisis and Argon crisis and a few other ones, what has actually happened was that the due diligence done by banks has gone up a lot. They've been asked to provide more services and to be custodian and more things than before. Lenders have actually worked on using companies like GDR, like third parties, to have third-party validation and verification of different things. And last but not least, the companies like PwC now are more called in to do valuations and to actually price loan portfolios and performance. And all of this, according to the panel, I would have thought makes the whole ecosystem more expensive and the margins go down. But the panel was arguing that it's not exactly the case. All of this is actually happening relatively cost effectively because they are replacing other older processes and systems which were not particularly cheap neither, just less good. So actually this whole change and evolution, it's, if anything, keeping the margins about the same, just changing who's doing what, where, and how.
So they're redistributing the job. They're not making them more efficient?
They are making it more efficient. It's a bigger job done more efficiently.
Got it.
For the same price.
The output's the same. Okay.
Yeah.
Interesting.
I think so.
How about the other event coming up on... This is the meetup event.
No, this is not. The meetup just went out yesterday.
Okay.
The next event is a conference happening in LA on July 19 and 20. It's about Reg A Plus and crowdfunding.
Okay. What does Reg A Plus mean to crowdfunding anyways?
I
should know this. I've been doing this for 42 episodes, George.
It's a new regulation.
Okay.
That allows companies to do sort of mini IPOs for very cheap. And if you have nothing better to do, you should also look at initial coin offerings, which is the blockchain version. Yeah, you should check it out.
There's good articles on that on Lending Times, right?
Yep.
Okay, I can just search for blockchain.
On Lending Times, not much. I think you just go to Google and search for ICO.
Okay. ICO, initial coin offering. Cool.
There we go.
Anything else you want to cover today, George?
No, that's it. We have a 25% off code for the Reg A Plus conference if you guys want to go to the website.
All right. Cool. And that's lending-times.com/events.
Yep.
Cool. All right. That sounds good. Let's wrap up this 42nd episode of the Lending Times podcast. Thank you from London and George from...
In New York.
All right. Thanks, everybody. Good night.
Thank you.